This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. Risk sentiment wanes as Fed and ECB officials debate the next steps on rates. Now investors await Jerome Powell's speech at Jackson Hole, plus Christine Lagarde speaks exclusively to Bloomberg. Meanwhile, China unveils further mortgage-easing pressures to bolster its property market in an attempt to support the world's second biggest economy. And former President Donald Trump was booked on charges that he conspired to overturn the 2020 election results. It is the first time Trump had his mugshot taken, which he promptly posted on social media. Welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie, stepping in for Danny Berger in London. Kriti Gupta in New York. Kriti, I'd love to talk about that stern look from the former president. I'd love to talk about the flurry of measures from China. I'd love to talk about luxury watches, and we will do all of that. But the gravitational pull of Jay Powell is undeniable. Yeah, the rally that we saw, I want to say, in the last 48 hours and then kind of unsaw could all be at risk as we hear from Jackson Hole today. What's important to keep in mind is the green on the screen that we saw, again, yesterday, driven by the NVIDIA rally, completely pared back, Tom. I mean, we were talking about this earlier in the week. Do we start to see these earnings become kind of some sort of hurdle to a bigger leg in the S&P 500? Is this a moment where you buy the rumor, sell the news? And it kind of feels like that is how it panned out on a longer-term time frame. S&P futures higher by 0.2%. No brainer here. It's a Friday. We have a little bit of a bounce back from yesterday's session. But here's what's crucial. The underperformer is the tech index. And here's where the NVIDIA story really comes in. The idea that it had such a big rally, it's only natural, just kick the technicals into play, to pull back a little bit. And that underperformance really is driving, again, the lack of enthusiasm for tech indices, not just here, but around the world. And that is going to be crucial. Pair that with the China story, and you aren't seeing sentiment with as much conviction, as much momentum as usual. The two-year yield gets interesting. We are flat on the day at the moment, but 5.03 on that two-year yield. Can it stay above 5%? What does Jay Powell say about whether 5% is the new norm? Remember, the theme of the Jackson Hole kind of academic symposium there is changes in the structural economy, and that really means, are we coming back to a 5% world? That was the read from Bank of America last week. And of course, let's go a quick check on the dollar against the euro. Euro dollar at 107. We'll call it 108 if you want. A little bit of weakness down, about 0.2% for the euro. That's the biggest contributor to the Bloomberg Dollar Index this morning, Tom. And Kriti, just picking up on your thoughts, your analysis around NVIDIA, the company obviously firing another arrow towards the bullseye of AI, but that arrow swiftly diverted past Europe because we just don't have those big linkages, the significant linkages that, of course, other US companies do, and arguably many of their suppliers do in Asia, not to the same extent, not to the same scale. And so actually, as a sector, you saw technology in Europe closing lower by more than 2% yesterday. It was the leading loss maker in terms of sectors. Now, today, the sentiment is a little bit more positive than the futures have suggested leading up to the European Open. You're actually seeing gains of around 0.3%. Some of that is coming through from China. Yes, a flurry of what have been described as pretty modest, pretty moderate measures, but it does suggest that at least policymakers are thinking about the concerns, addressing some of the concerns, and maybe long-term, if they are implemented, it could lead to a lift. Also, basic resources, iron ore, copper up as well. So that's lifting the FTSE 100, it's lifting the basic resources sector. Now, gilts and debt here in the UK. Some of the best performing sovereign debt this week as investors rethink how far the Bank of England is going to have to go because the data is looking soggy here in the UK. OK, today, yields are edging a little higher, 2 basis points. But the weekly story is the gilts have been bid this week on a change in those expectations around the Bank of England. Here's the corporate story I wanted to flesh out for you around luxury stocks. It's a Friday, so we can talk about luxury timepieces. Watches of Switzerland, listed here in London, taking a deep dive, 23% on the back of this news, and it's shaken up the luxury world. That Rolex is actually buying a major retailer, Bucherer, in Switzerland. They have about 100 stores around the world. Rolex has always said, we're not getting involved in retail. Now it seems they are. And Watches of Switzerland, one of the competitors of Bucherer, falling heavily on the back of concerns as to whether or not they'll get that supply of Rolexes going forward.
The watch industry is so interesting from a macro perspective as well, just given that you can talk about kind of whether there's that consumer disposable income. I think there's so many celebrities who are now actively investing in kind of the second-tier watch market that, who knows, could be some sort of beacon of inflation at some point. We know that's certainly the theme around the world, especially at Jackson Hole, as central bankers are gathering. Of course, investors at the same time waiting for more clues on the outlook for those interest rates. Former St. Louis Fed President James Bullard spoke on Bloomberg about the impact of the strong economic data.
Reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy.
Joining us now, Bloomberg's Eddie Vanderwall, the deputy managing editor over at our Markets Live blog. Eddie, Jay Powell, not unlike yourself, is kind of a reserved guy. He picks his words very, very carefully. How much of what he says is actually going to move the markets? What could he possibly say that's going to change the narrative?
All I can say is thank goodness that my words don't have the same effect on markets. Look, I think Powell, at the moment, he won't want to come out and say, hey, job done against inflation. But I do think that he will want to subtly shift the tone a little bit more dovish, because inflation has been coming down. Now, of course, we had that one uptick in the most recent reading, but we're seeing the core numbers starting to come down. And I think they want to account for the lag effects. And we've already seen that in that they are talking more about data dependency, less about forward guidance, which of course means more volatility in markets, because if you're not going to tell markets what you're going to do, then every data point shifts the narrative. But I think at this particular juncture, Powell will want to set the tone for what they do going forward. And I think he knows that they are shifting to a slightly more dovish stance, more focusing on that support for the jobs market than they are, really taking the fight to inflation. And of course, that will feed through into tech stocks again.
Eddie, do you think there's going to be a pushback? You've outlined there what you think we're going to hear from Jay Powell, but a pushback maybe on the market pricing around 100 basis points of cuts for 2024. Does that seem overly aggressive? Are they underpricing? How much is going to come through in terms of cuts in the face of maybe a US recession? How are you thinking about the market pricing into 2024?
Yeah, there's still a really interesting split, right? Because I think if you ask Powell, if Powell, if you were to ask him privately, I don't think he would say anything like that is likely, because I think the market at the moment is pricing for a hard landing and therefore the Fed being forced into cuts. I think Powell shifts slightly more dovish, but the market shifts slightly more hawkish, if that makes sense, because I think Powell will want to say, look, we are closer to that path for a soft landing. We won't have to hike as aggressively as we have in the past, and that therefore we're going to see rates probably staying at this higher for longer rate. But therefore the market has to shift slightly up in its expectation for rates next year. Still, I think the read through to equities would be slightly more bullish than it is for the bond market.
OK, Eddie Vanderwelt from our MLive team, thank you very much indeed, with the preview there of Jay Powell's all-important speech later today. Meanwhile, ECB President Christine Lagarde will also be speaking at Jackson Hole today, and Governing Council member Joachim Nagel says he is not convinced inflation is under control, not enough at least for a halt in interest rate hikes.
When you talk about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%.
OK, joining us now is Maria Tadeo. Maria, the Bundesbank president is hawkish. Shock horror. Is it too late to talk about a pause?
Look, when you listen to that interview, I don't think he gives any leeway to suggest that at this point today, the day that we speak, he would be inclined for a pause. I think he says this also very openly. When you see inflation, which is still above target, and he believes is still stubbornly high, the central bank has a responsibility to remain stubborn on bringing down that inflation. He did say, maybe to add some nuance here, that of course any future decisions from the European Central Bank will hinge on the data, which of course reflects the line that Christine Lagarde Lagarde introduced in July when she said there could be a hike or maybe a hold, but all of this will be determined by the data. The paradox for the German economy is that on the one hand is one of those countries that is still seeing inflation remains a problem, but it's also one of the countries on the receiving end on the economic downturn. When you look at the indicators that we got this week, be it the PMIs or the surveys that we got today, it does show that this is an economy that is still hurting. To me, it was interesting in that interview how Mr. Nagel, as the head of the German central bank, kind of pushed back on this idea that Germany has somewhat become the sick man of Europe. This has, infuriated some members of the German government. But to me, I was also struck by the head of the central bank coming out and feeling like he had to publicly defend his country, saying do not underestimate the capabilities of the German economy. The problem, as I say, is that when you look at the numbers, they do not paint a positive picture for the biggest economy in the euro area.
Where does President Lagarde stand in all of this, Maria? Of course, we do have an interview with her due from Jackson Hole on Bloomberg Television later in programming. But what could she possibly say to perhaps change that narrative?
Look, we have a keynote speech and we have an interview, of course, with Tom Keene that is coming up today. And it's also an interesting timing because this is the first time we hear really from the head of the European Central Bank ever since that July meeting and that introduction of potentially a pause in September, always looking at the data. Remember, she said it would not be up to me. It will really hinge on the data. Are we going to get an inclination of what that decision looks like? I really doubt it, especially because, look, she's not going to move until the forecasts come out, and that will be in September, but the tone will be key. What is interesting to me, too, is that, again, you highlight the difficulty of this job. You see the German central bank saying, I don't see a reason to pause. You speak to the Portuguese, they say we need to factor the downturn in the economy. She has to bring them all together and come up with a consensus decision.
Maria, today in Brussels, we'll be looking out, of course, for that interview with Christine Lagarde. Some people in London will have to put down their pints at the local boozer to tune in for that one. You can't talk about Europe without talking about China, of course, and China unveiling a further easing of its mortgage policies to halt a slump in its residential property market and revive growth in its economy. Joining us now with the details is Bloomberg's China and Economy Government Editor Jill Desis, who does such a great job charting the evolution in this economy. Jill, what do you make of the flurry of measures on mortgages, on taxes around stock trading, and indeed the efforts by regulators to compel some of the money managers in the West and on Wall Street to stick with it when it comes to Chinese stocks?
Well, that was quite a mouthful, Tom, and I think it's worth parsing through some of these things. I think that, you said the mortgage rules in particular, you described them as modest earlier. I think that's pretty apt. So essentially, to break it down, in major Chinese cities, there's a rule that if you've ever held a mortgage, even if you fully paid it off, you can no longer be considered as a first-time home buyer. And so that, of course, precludes you from perhaps more favorable down payment restrictions on how much you actually have to put up to then get another home. So what the Chinese government put out today was saying that local governments can consider removing those rules, and so that could potentially help things out. I think what's really important to remember here, Tom, though, is that the central government was essentially leaving it up to these local governments to then implement that rule. So this really, I think, only has a lot of heft if it's employed in the largest cities. In Beijing, for example, I think if you're a second-time home buyer, you have to put up a down payment of something like 80%. Whereas like a first-time home buyer would be like, 40%. So, I mean, those are the types of cities where you'd actually have to see action really, really take hold for you to see something that actually makes some meaningful movement in the property market. That being said, I think that the fact that these rules are even being eased whatsoever maybe portends some additional steps that the government could roll out in the coming weeks and months that actually help the property sector. So it is, I think, a positive step forward. It's just not enough to make a substantial change right now.
80%. Oh my gosh, that's an enormous number. Jill, let's talk a little bit about the other China piece, if we can. Going into next week, we know Gina Raimondo, our Secretary of Commerce, is going to China specifically. Looks like chips will be on her mind. What can we expect out of that conversation? Anything positive? Anything negative? Walk us through it.
Yeah. Yeah. I think that ultimately, Kriti, the Commerce Secretary visiting Beijing is, I think, one of the most positive step forwards that you can really kind of, engineer for the U.S.-China relationship at this point. Now, look, we've had several high-profile visits to Beijing by prominent U.S. officials. You've had Antony Blinken, Secretary of State, Janet Yellen just visited. We haven't really seen a whole lot of fruitful measures take place within a lot of those meetings. But I think that the thing with Raimondo is that, the U.S.-China trade relationship is obviously incredibly critical. She's visiting China at a time when we've seen, some heightened investment restrictions on, American investments in AI and quantum computing as it relates to China. We've seen, some other restrictions. But what Raimondo has the opportunity to do is sort of smooth out, to the extent that it makes sense, the U.S.-China relationship. Maybe it involves removing curbs in other ways. I mean, we just saw earlier this week what I describe as a bit of an olive branch, the U.S. Removing some restrictions or, taking some Chinese companies off of a list that precludes them from, working with some, American companies. So there is opportunity for her to work within that sphere to try to figure out ways in which the U.S. and the Chinese economies can continue to cooperate, even if the U.S. wants to protect, some sectors on national security grounds or what have you.
OK, Jill Deeses, thank you very much indeed, laying out the implications of those mortgage changes and previewing Gina Raimondo's important visit, of course, to Beijing in the next few days. Thank you. Coming up later this hour, we're going to catch up with Sarah Hewin, head of Europe and America's research at Standard Chartered. Her views on where central banks go from here. And, of course, our coverage of Jackson Hole continues throughout the day. Catch a special edition of Bloomberg Surveillance. That starts 8 a.m. Eastern Time. We're going to hear from an all-star lineup, including Philadelphia Fed President Patrick Harker. And we're going to bring you, of course, Jerome Powell's speech live, 10 a.m. Eastern. Plus, don't miss that exclusive interview with ECB President Christine Lagarde. She's going to speak to Tom Keene at 4 p.m. Eastern Time. So much on the docket to stay tuned for. Stay with us. This is Bloomberg.
What has taken place here is a travesty of justice. We did nothing wrong. I did nothing wrong. And everybody knows it. We did nothing wrong at all. And we have every right, every single right, to challenge an election that we think is dishonest.
Former President Donald Trump there speaking yesterday after turning himself into a jail in Atlanta, Georgia. He was booked on state charges that he conspired to overturn the result of the 2020 presidential election in Georgia. It's the first time Trump had his mugshot taken, which he then posted on X, formerly known as Twitter, marking his first return to the social media platform since January of 2021. For more, we're joined now by Bloomberg's Bill Ferry, a senior editor and former U.S. national security team leader in Washington, D.C. Bill, a pleasure to have you on the program. Talk about the strategy for us. I mean, we know in previous arraignments, it's been a very kind of hush-hush process for the Trump kind of campaign and for President Trump himself and his legal team. This seems to be a little different. What do you make of it?
Well, it's the fourth time the president has had to go in to face these to face charges. In the past, officials did not want to take a mugshot. They said it wasn't necessary. This time, the sheriff in Fulton County said that no one was going to get special treatment. That's why you saw former President Trump and much of his legal team, 18 co-conspirators, all have mugshots taken. For him, the legal cases have not been an impediment. He's still, of course, leading the Republican side of the race, the primaries, to be the candidate for president next year. He was able to skip a debate earlier this week. He has effectively been Teflon, but there's a real question about whether the schedule ahead in terms of these court cases and the demands of the trail, the campaign trail, mean that some of that support will erode. We'll have to wait and see on that.
Bill, he pulled out the blue steel look for that mugshot. What comes next from the former president?
Well, the prosecutor in this case is hoping to have this case really get expedited. She wants an arraignment next month and the trial to get underway. President Trump's lawyers, not only in Georgia but everywhere where they've had to face charges, have been pursuing a strategy of pushing things off as long as possible. They've proposed dates for hearings that take place after the November 2024 election. It's doubtful that the courts are going to go along with all of that. We know he has one court hearing in New York in late March, and that's just 2 weeks after the big Super Tuesday primary. So by the time we get into the meat of 2024, you're going to see the president having to leave the campaign trail for court appearances and then running to get back out and give his speeches or hold his rallies like we saw in 2016 and 2020.
Wow. That's going to be quite something, isn't it? Historic, obviously. Bill Ferries, thank you for the latest on the travails of the former president and what it means for his standing. Of course, still has that healthy poll lead amongst Republican candidates. Coming up, Hewin Electric facing multiple lawsuits on the handling of that deadly wildfire. More on that next. This is Bloomberg.
This is Bloomberg Surveillance, the early edition. I'm Kriti Gupta in New York with Tom Mackenzie in London. Let's get to some of the stories that caught our eye this morning. The lawsuits piling up for Hewin Electric on claims that the utility company's compromised safety protocols put the island at higher risk from the damages of the deadly wildfire. The firm is facing liabilities of almost $4 billion, and if it's found negligent, according to research firm Capstone, the Maui fires destroyed much of the city of Lahaina and killed more than 100 people. Now let's turn to some of the earnings stories as well. Gap delivering sales and revenue that missed the street's estimates for the last quarter. Nordstrom, on the other hand, posting lower than expected losses at its off-price rack stores. Nordstrom CEO also highlighting that losses from the theft are at a historic high, adding to concerns over the health of consumers after Macy's cited accelerated credit card delinquencies earlier in the week. And over in Hollywood, Warner Brothers delaying the release of the film Dune Part 2 from November to March 2024. That comes amid the ongoing strikes in the industry that prohibit actors from promoting their work for companies that they are striking against. The Screen Actors Guild went on strike in July, seeking changes in a new contract, including higher pay. Tom, this situation getting worse and worse. And, I've spoken to folks in the industry and they say that it could really last almost even a year. And you're already seeing some of the studios really kind of lean into that. We're going to talk about the economics effect of the strike story across both sides of the Atlantic. Coming up, Sarah Hewin, Standard Chartered Head of Europe and America's Research, joins us next. This is Bloomberg. This is Bloomberg Surveillance, the early edition. Here's what you need to know. Risk sentiment waning as Fed and ECB officials debate the next steps on tackling those interest rates. Now, investors awaiting Jerome Powell's speech at Jackson Hole in Wyoming, plus Christine Lagarde speaking exclusively to Bloomberg TV. Meanwhile, China unveils further mortgage easing policies to bolster its property market in an attempt to support the world's second biggest economy. And former President Donald Trump booked on charges that he conspired to overturn the 2020 election results. It's the first time Trump had his mugshot taken, which was then posted on social media. I'm Kriti Gupta in New York with Tom Mackenzie stepping in for Danny Berger in London. Tom, there's a lot of news from around the world, from China to D.C., but when it comes to the market trade, all eyes on Wyoming.
Absolutely. Even here in Europe, of course, that is where the focus is. Will we get some kind of clarity from the Fed Chair, Jay Powell, in terms of the next steps from that central bank? A reiteration of the need to be data dependent. We also heard that from European central bank officials as well. Nagel over at the Bundesbank of Germany saying that he does not see the case yet to close the book on further interest rates. He still sees resilience in the Eurozone economy, and so for him at least, keeping the door open as a hawk to further rate hikes coming through from the ECB. But the sentiment here in Europe is modestly positive. We've had a few catalysts coming through from China in terms of further modest moves, at least to try and shore up that economy. And across the benchmark here, you're seeing gains of 0.3%. When it comes to the debt markets, there's been a lot of focus, of course, this week, rightly so, on what's been happening in the US Treasury markets. But actually, the best performer in terms of sovereign debt has been UK gilts as we reassess and readjust to the ability for the BOE to go higher with rates, maybe pairing some of those bets, the markets, and that is leading to money moving in this week. If today is a bit of an outlier by 2 basis points, a little bit of sell-off, but the weekly story is gilts have been bid. One of the corporate stories to bring to your attention, we touched on this earlier, luxury watches and I wonder if you've got a Daytona on your wrist there, Kriti. It's watches of Switzerland under pressure because Rolex has gone in and bought a major retailer in Switzerland. They've never done this before. They haven't had that retail experience and that exposure, and there's concern from some of the competitors in the retail space, like watches of Switzerland, listed here in London, that maybe they will get a shortage of supply of Rolexes. That stock taking a hit down 0.2%. When it comes to luxury timepieces, that's the story, Tim. Kriti.
Tom, I have to admit, I'm not quite at the caliber of a luxury timepiece yet. In fact, this one is one I bought in high school with my very first paycheck for about $100, and I'm still wearing it. So a luxury timepiece is perhaps a few steps away for me. But anyways, the green on the screen you were seeing stateside is a direct read-through, I think, from what you're seeing in the European session. Although underperformance in the tech sector seems to be a key theme. It's really diverging from that kind of NVIDIA hullabaloo, we'll call it, when it comes to just how good their earnings were. A lot of people front-run those earnings and then ended up selling the rally that you saw post those numbers coming out. So you did actually see some of those movements. The S&P 500 higher by 0.2%. We're going to get you the graphics back in just a second. But what you need to know here is that the underperformance is crucial. The bond market also getting very, very interesting when you look ahead of Jackson Hole. Remember, the 2-year yield not doing a whole lot at the moment. And even Eurodollar, which is the biggest contributor right now to the Bloomberg Dollar Index, again, only weaker by 0.2%, Tom.
OK, let's get more then on Jackson Hole and the conference featuring central bankers, of course, from around the world. Bloomberg's Michael McKee, none other, filed this report on what to expect today from the conference.
Friday's symposium comes in two parts. One of interest to global Wall Street at 10 Eastern when Fed Chair Jay Powell speaks, and later at 3, it's ECB President Christine Lagarde. Neither is likely to deliver what investors want, clear clues to the timing and path of interest rates ahead. Instead, expect them to reiterate inflation is bad and they will keep the rate pressure on. What they won't say is whether that means higher rates longer, or both. In between their keynotes, the central bankers and economists here will turn to the topic of the symposium, structural changes in the global economy. The post-pandemic economy already looks different. They'll discuss what that means for monetary policy, but in the longer run. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
OK, let's bring in Sarah Hewin now, head of Europe and America's research at Standard Chartered. Good morning, Sarah. Thank you for joining us. What kind of message do you expect to hear then from Jay Powell? Is he going to be centrist? Is he going to lean hawkish? Or does he have the space now to suggest that maybe we are in peak territory?
I think he's going to be quite cautious about giving a firm indication that rates are at a peak now. So we're expecting still a hawkish lean. That said, the message of data dependency is going to be central, I think, both for Powell and Lagarde. The jury is still out, I think, in terms of the direction of inflation, the direction of the labour market in the US. But we have seen some encouraging signs. Core inflation pressures do seem to be easing. Input pressures are fading. And of course, we've had a couple of months of slower employment gains in terms of the payrolls. So those are all very encouraging messages, but at the same time, Powell won't want to signal that the Fed is done just yet. So we're expecting more a sort of cautiously but somewhat hawkish message, I think, from this meeting. That said, they don't want to be too hawkish. There are some concerns about over-tightening, that policy goes too far and really brings the economy down further than it needs to.
It is, of course, a very fine balance, as you kind of outlined there for us, for Jay Powell. How difficult does that make it, Sarah, for you and the team at Standard Chartered to project into 2024? The market's pricing in, at this point at least, 100 basis points of cuts from the Fed by the end of next year. Does that align with your view?
That broadly aligns with what we're expecting as well. I mean, we're not expecting rate cuts to start until the early months of next year. We think that, of course, policy is still going to be in restrictive territory, even if you get 100 basis points of cuts. So that would still suggest that the Fed is fighting inflation. And 100 over the course of a year is a very sort of gradual decline. and still recognizing the need to bring core inflation all the way back down to 2%. But the signs are very positive that we're moving in the right direction. Of course, today it's highly unlikely that we get any signal from Powell that there are any rate cuts on the horizon. That's the last thing that policymakers from the Fed or indeed from any of the central banks, the Bank of England, the ECB, that's the last message that any will want to deliver at this moment.
But then pausing kind of more than just one meeting at a time isn't exactly the best vote of confidence either, it feels like, for the markets. Sarah, talk to us a little bit about the divergence in terms of that framework between what you're seeing from the Federal Reserve and from the ECB. Is it a problem that they don't seem to be on the same page at the moment?
In some ways, they are on the same page, of course, because the latest comments that we had from Lagarde and from Powell at the last policy meetings were that, we could raise rates, we could cut rates, that they very much emphasized data dependency, and both really stepped back from the earlier message, which was for ongoing tightening of rates, a clear forward guidance that there were further rate hikes to come. So both really left the September policy meeting with a question mark over whether indeed there would be a need for further rate hikes. But at the same time, both Lagarde and Powell shied away from any suggestion that rates are definitely at a peak. For the ECB, the problem is that the downturn in inflation has been very tentative so far. We may get more news in that respect next week. We're expecting that we will see core inflation and headline inflation coming down again in the euro area. But there are real concerns about wage pressures still in the euro area and the impact that that might have on core inflation. For the US, there are, in our view, very clear signs that inflation is on a downtrend. If we look at the latest monthly data annualized, then you have a lot of comfort that inflation is heading towards the target.
And Sarah, at the core of that, though, is going to be, when does this kind of recession call happen? Even the folks that are still sticking to the recessionary calls, at least stateside, are calling it a modest recession in 2024 even. It doesn't feel like those same calls are coming for Europe, where perhaps a recession could be a little bit more dramatic. Are you at all worried about, again, the timing of that?
Yes, the real dilemma for euro area for ECB policymakers is that the data, certainly the survey data, are looking very poor. We've got purchasing managers indices, we've got the IFO indices now at levels below the troughs that we reached last October. And if you remember, that was the point at which there were real concerns about the energy crisis and the impact that that would have on growth in the euro area. So the recession signals, I think, are pretty heightened for the euro area, potentially for as early as the current quarter, turning down again. For the US, the current quarter still seems to be very comfortably in positive territory. We're seeing perhaps some easing of activity, but there's certainly no signs that a downturn is imminent, although we think that the impact of the accumulated impact of higher interest rates over the past 15 months or so is going to ultimately be negative for the economy. So we still see a risk of a recession in the US.
Yeah, so resilience or recovery, and it feels like Sarah Hewin is leading a little bit more to the resilience story. Standard Chartered Sarah Hewin, we thank you, as always, for joining the program. Our coverage continues of that Jackson Hole, continuing throughout the day, catching a special edition of Bloomberg Surveillance. It starts at 8 a.m. Eastern. The team is on the ground. We're going to hear from an all-star lineup, including Philadelphia Fed President Patrick Harker, and then, of course, bring you Jerome Powell's speech live at 10 a.m. Eastern Time. Plus, don't miss an exclusive interview with ECB President Christine Lagarde. She speaks exclusively with Tom Keene at 4 p.m. Eastern. This is Bloomberg. All eyes on Jackson Hole, Wyoming this morning on both sides of the Atlantic as, of course, we talk about what Jerome Powell and Christine Lagarde and their central banking colleagues are really going to say about the path of interest rates at a time when you were still seeing about 100 basis points of cuts priced in for next year. And for our radio audience, stick with me. For our TV audience, I am showing you a chart right now about exactly what that looks like. I mean, nothing has really changed in terms of the market pricing, I think, in the last year or so, where they're still saying, look, that downturn that we're really expecting might just show up in 2024, and therefore the market is expecting 100 basis points of cuts. Is that reasonable, given the resilience we've seen in the economic data lately? Let's get a true expert's opinion on this. Bloomberg Opinions columnist Marcus Ashworth joins the program. Marcus, is that reasonable? Does the market have it right?
I have actually absolutely no idea. I don't think the market does either. And nor, I think, does the Fed, really. All the Fed wants to do is make sure that doesn't get any worse, in the sense even more rate cuts priced in, or more accurately, priced in earlier. They want to buy themselves time to get through into the first quarter next year with this higher for longer mantra, this plateau of rates. I don't think they'll go up much more, if at all. But they don't want this sort of, oh my word, they've paused, it must mean the end of rate hikes. Instantly we start pricing lots of cuts, because that then takes out all the momentum in this monetary pricing policy tightening they've done over the last year and a bit now. So it's a game of chicken with the market. If, for instance, Powell mentioned something about policy already being restrictive, or he would say too restrictive. He's going to sound generally hawkish, but the hints, the nuances we're after is, does he say anything about monetary time lags and how restrictive policy is? That'll be the clue for the market to rally. He probably won't want that. I think he's pretty happy where the bond yield curve is priced now. I think he will be slightly unhappy, as you're showing in that excellent chart, that 2024's expectations of rate cuts are probably a bit more than they like to see.
The game of chicken there with the markets for Jay Powell. Marcus, talk to us about how you fold that into your views around treasuries then. There's this kind of debate going on still. You have the likes of Stephen Major over at HSBC saying rates at these levels, particularly the 10s and the 30s, they're looking pretty attractive. But you have the issuance question coming from the US Treasury. You have, of course, the inflation implications. You have, of course, quantitative tightening as well. What is your view as you kind of project out to 2024?
Well, I mean, I think I sort of agree with that view generally. I think bonds are looking pretty cheap. I have to say, I thought they were looking quite cheap, a few basis points lower as well. So I'm slightly surprised at how aggressive the bond move has been, higher in yields. It's partly a supply argument, it's partly a budget deficit, and I think possibly a China story as well, or a fear of China selling. Whether the reality is or not, we don't know. But I think the market is definitely overshot going to Jackson Hole. The chances it will want to rally quite hard, especially if Powell says something dovish. So, as far as Treasury is concerned, I think it's had a very, tough time of it. And I think probably the market's going to settle down. And I would say overall, this is a good time to buy bonds, but, you may get a better trade location.
Marcus, what does something dovish actually sound like when we already know that the economic data, it is slowing, not dramatically, but it is slowing across the consumer sector, across the business sector, and even exports, imports data showing that as well. How much more dovish could Powell get?
Well, I think Powell's been pretty hawkish, and certainly this time last year, he was very hawkish. It was the most hawkish speech I think I've ever listened to, certainly in modern history. I don't think he'll repeat that, but he's not going to be as dovish, for instance, as he was in 21. So he's going to steer somewhere to the middle of those last two speeches, probably closer to last year's very hawkish speech. He's going to be hawkish. I think the market expects him to be hawkish. We know he's going to say higher for longer. We know he said there may be a need for more rate hikes. And he certainly doesn't want, as I said, to get in these rate cut mentality next year building in any further. However, words like restrictive or lag are the key things. If he mentions that in a certain way, I think the bond market will take that as fairly positive and in a sense, interpret a hawkish speech as a dovish version of it.
Marcus, are we still worried about financial pricing inflation, asset price inflation? If we're seeing green on the screen driven by the AI story, is that interpreted as a positive or a negative in Wyoming?
Oh, I think a negative in the sense they don't want to see too much of it. They understand how markets are and how bubbleicious they're going to continue to be, particularly in things like Nvidia. But I mean, I don't think they want to see this spreading out like obviously we had the meme stock issue a year or so ago, which was getting out of control. I don't think they'll view one game-changing stock as being necessarily something to worry about too much. But they can see the S&P has calmed down a bit. I think they'll be quite happy with that. I don't think they want to cause a stock market collapse, but certainly I don't think they want to fuel any more asset prices. So it'll be a minor and a negative, I think, from generally, but has been for some while. I think they want to try and slowly ease this stuff out of the stock market. That may mean flat prices and not necessarily a down market.
Marcus, very briefly here on the UK, gilt yields edging up today. It's not the story of the week, though. Gilts have been bid, and markets and traders are now pricing in below 6% in terms of the terminal rate from the Bank of England. I know you have very strong views on what they should be doing at the BOE. What do you think they will be doing in light of the weaker data here?
Okay, I think the Fed probably doesn't hike again. I think the ECB almost certainly can't hike again. Having said that, the Bank of England probably almost certainly, definitely will have to hike one more time, but that probably will be it. So I think 5.5, maybe 5 3/4 as at the moment makes sense. I think the market's coming down to that sensible presumption because the PMIs are so weak, because the ECB will be pausing, and maybe the Fed does as well. If the Fed decides to hike again, all bets are off. Maybe we do get to price in 6% again, but for the moment, I think the logical sort of peak rate to price in, with a little bit of hedging there, is 5 3/4. Though I don't think they'll get to it eventually.
Marcus Ashworth, we could have you for an hour and still not pick your brain completely. We appreciate you joining the program this morning, joining us from Bloomberg Opinion. We thank you as always. Coming up on the show, a look at some of the stocks moving ahead of the U.S. market open. This is Bloomberg. This is Bloomberg Surveillance, the early edition. I'm Kriti Gupta in New York with Tom Mackenzie in London. Let's take a look at some of the stocks we're watching in pre-market trading in the U.S. Now, remember, it is a summer Friday. All eyes are on Jackson Hole, so there are slim pickings here stateside. But some of the big major market movers, Hewin Electric down about 20% in the pre-market. Shares trading about $9.49. Look, they're dealing with multiple lawsuits from investors, but also from Maui itself, and also talking about suspending their dividends. So seeing some real pain in those shares right now. And of course, we'll bring you the latest fallout as we get it. But right now, under quite a bit of pain. NVIDIA is also another major stock we are watching this morning. NVDA is your ticker there. Shares higher by 0.3%. But Tom, this is not the momentum we've seen in the last, 48 hours or so around the artificial intelligence boom. Remember, you had a lot of folks front running these earnings stories. Then ultimately selling the rally in yesterday's trade. And again, perhaps not catching that second wind this morning.
Yeah, it certainly didn't hold in Europe, where you actually saw tech stocks as a sector down a full 2+% yesterday at the close. I also want to bring your attention back to the luxury stocks story, the luxury watch story, part of the luxury stock story, because this really surprising move for anyone who follows luxury timepieces, Rolex moving into the retail space, and the impact is being felt on Watches of Switzerland. It's listed here in London. It relies, according to some analysts, on about 50% of its sales coming from Rolex. The concern from Watches of Switzerland is that it's now going to be competing with Bucherer, which is a retail luxury watch seller, and they may be squeezed in terms of supply. So a big hit there and big changes in the luxury watch space.
It's so interesting how quickly the luxury watch space has kind of entered the conversation in terms of inflation broadly, because it's not really something I think about often when I think about inflation, but it's actually part of some of the inflation indices, which I think is fascinating.
Yeah, you saw that pandemic push, didn't you? That rush into some of the pricier timepieces. And the likes of Patek Philippe and Rolex benefited from that as you got your stimulus checks and spent them either on Bitcoin or luxury watches. And that is now coming off a little bit. So maybe a little bit of disinflation in the pricing there.
Yeah, and ultimately kind of an investment, right? I mean, if you have that extra cash, why buy a car or a house? Just buy a Rolex, apparently. And that can,
invest
of course,
in a beautiful selection of luxury watches. Hey, the other big story of the day, Kriti, so I've heard on the grapevine, is that a loss for New York is going to be a big win for London. It's your last day on set in New York.
It is my last day on set. I've got to say it's bittersweet because, look, I've been at Bloomberg for about 5 years now and all here in New York doing some stuff on the print side and the TV side. And yeah, I'm crossing the Atlantic, braving new waters, if you will. But it's been quite the ride.
We welcome you with open arms. We're really excited about welcoming you here, Kriti. I know the team in New York are going to be sad to miss you, but we are going to be seeing you here on the ground in the studio here in London in the next few weeks. We wish you well, of course, with the move. It's a big uplift. Kriti Gupta, I'll let you close it out.
Daybreak Europe, 6 a.m. in a couple of weeks. Thank you to their team. Thank you to our audience. Folks, stick with us. Early edition ends right now. Surveillance begins. Coverage throughout the day. This is Bloomberg.